Welcome everybody, my name is Leif Seneberg.
And my name is Alessia. Brütsch.
And today we present the Helvetian Investment Club, the largest student finance association in the German-speaking region, and especially here at the University of St. Gallen. Today we are honored to be welcoming Dr. Dibelius, Managing Partner and Head of DACHI in Israel at CVC Capital Partners. During our discussion, we will explore his career transitions, his time at Goldman Sachs, and what makes it a breeding ground for exceptional talent, as well as the evolving role of private equity in today's uncertain economic environment, and much more. After discussing these topics, you will have the opportunity to ask your most burning questions directly to Mr. Dibelius. But before we start with our Q&A, I believe Alessia has some further words to say.
So hello everyone, and a warm welcome. Is it working?
Oh yeah.
It's a gender-biased microphone.
Probably.
So, Mr. Dibelius started his career in medicine. After getting his PhD, he worked as a surgeon in both South Africa and also at the University Hospital in Freiburg. In 1987, he joined McKinsey, where he was promoted to partner after only 4.5 years. In 1993, he took up a position at Goldman Sachs, where he initially focused on M&A in New York. He then was also promoted to partner and then also took on several leadership positions, such as Global Co-Chairman of Investment Banking and CEO for Germany. He worked on high-profile transactions such as the Vodafone-Mannesmann deal, which is up until today the largest deal that ever happened. Since 2015, he has been managing partner and head of DACHI in Israel at CVC Capital Partners, focusing on investments in the region. It is an absolute pleasure having someone with such a unique career and extensive experience in the financial service industry with us today. And now join me in welcoming Mr. Alexander Dibelius.
Thank you. You kind of learned my career by heart. You know, it's always interesting to hear it then from other people, because sometimes you say, do you know this guy? And I sometimes even don't know him. One question before we start that, and sorry for doing that. Is there anybody from the press in the room? No, thank you. It's important for me to know, because I happened to have a small incident when I did, and I shouldn't mention that, when I had a presentation like that to WHU. Who's WHU? You might ask yourself, yeah. No, but there, somebody asked me, do bankers have an obligation to the public good? And then I told them during the session, no, I don't think that they have an obligation to the public good to lend money at not risk-adjusted returns. And somebody from Reuters was there. And when I came out of the meeting, there was on the screen, Dibelius says, bankers have no obligation to the public good. Which obviously 5 minutes later, Mr. Kampeter from the German Chancellor recalled and said, you know, it's not possible and we will not do any business anymore with Goldman if you kind of have this position. So that's why I'm always careful, because it allows me to speak more openly if no press is there. And if I make the statement, everybody who's kind of undercover press here would do an offense, so to speak, a criminal offense, even if we would then write and report to the broader public. So that's clear, so then I can speak more open and lively, so to speak. Sorry for that.
It's okay, no press in the room. Thanks for elaborating on that. Yeah, with such a demanding role at CVC, to maybe start it off a bit on a light note, I imagine your weeks must be quite busy. So how does the head of DACHI at CVC Capital Partners usually spend his weekends or generally his leisure time?
My leisure time, you know, I spend with you to give these kind of speeches. No, seriously, I obviously have a family. I have 5 kids. I had, if I kind of, with in hindsight, look at my career, I had kind of front-loaded the career with professional experiences, and the private experiences came somewhat later. So I'm a late father. I have 5 kids, you know, ranging from 18 to basically the youngest one now, 3 months. So from that perspective, you can easily imagine what my weekends look like, you know, playing horse for my smallest one, doing sports with the middle girls, going to Douglas and show them the newest collection, and my oldest one has just started to study medicine, so I have to give him some lessons about the tuberositas deltoidea and all of that. So that's basically my thing. But in general, I try to kind of, I've been able to manage now that I'm at least, or not more than 2 or 3 nights away from home during the week.
Thank you. So during our prior communication, you actually mentioned that our HIC community here had lots of Goldman Sachs representation, and even though I did not notice it myself, it's actually true. We had Fink, obviously, but also Dr. Achleitner or Mr. Wiedlisbach from Partners Group. I think that's probably not a coincidence that we invite people who have been at Goldman Sachs once in their career. So maybe from your point of view, what is it about Goldman Sachs that makes it such a strong breeding ground for exceptional talents and successful professionals?
Thanks for the question. Obviously, you had my successor and the guy that I hired, Mr. Fink, here already. Now you have to probably the chance to compare if he kind of has the same answer or is answering the same thing as me. In general, it is sort of a self-reinforcing organization who kind of tries, and it's, by the way, the same true for McKinsey and every other high performance organization, that they kind of spend a tremendous time of selecting the right people and trying to kind of integrate them. And not everybody the same, but at least something where they can understand that they kind of support the same culture. And it's a culture of achievement, a culture of meritocracy, and that is something that I think keeps them all together and keeps them together over a long, long time. And that's why a lot of people aspire to kind of join Goldman or other high-performance organizations. I think that's the key, and if that is kind of implemented in the right way, the success of these organizations, these as high-performance organizations, comes automatically. So from that perspective, it is very much dependent on the selection of the right people. And everybody of you who is sitting here has already, to a certain extent, already achieved the first step in that regard, because you have kind of managed to be in a quote-unquote, despite politically not correct to say that these days, unfortunately, with all this wokeness around us, in an elitist university or business school or whatever you want to call it. And, I think, but that's now getting too political, that this is kind of something that we as a society have to kind of support, and we shouldn't feel bad about it. And with this first step in a top education, you're as well making the first step towards a top professional service organization if you wish to be there. There are as well other careers. And then this self-reinforces itself then to kind of create a high-performance organization. By the way, and that's, sorry if I kind of diverge a bit, not everybody has to be the same and everybody has to be uniform. Because as we know, diverse organizations, I mean that not only gender diverse, are better performing organizations. And I'm always kind of saying, if you have, everybody of us has different spikes with regard to talent. Somebody speaks great, somebody is a great mathematician and so on. If you kind of try to visualize the spikes that somebody has, you have one person that has a spike here, then another person that has a spike here, another person has a spike here. So if you kind of have diverse talents, these spikes are kind of giving you the performance often, or the line that you get then through the spikes gives you the organizational performance. Whereas if you have only non-diverse people, everybody has the spike at the same place, then the organizational performance is lower. Yeah. So and that's why I think good education, yet being diversified with regard to your mental strategies and your upbringing, and then joining these organizations. That's what makes success, and then that kind of attracts the same type of people, and then that's a self-reinforcing organization. And if the culture can be maintained, then this is something that's just as well fun to work.
Is that also why you have expressed a preference for recruiting talent from Goldman Sachs for CVC, as noted in a previous interview?
True, but I at CVC is or the buy side is a different business. It's not as people intense. We don't have that many people. I've been leading a Goldman 5,000 people or something here in now my team is 16 people. So from that perspective, the recruiting function as such is not so important, because I think, all 2 or 3 years I lead one person, whereas in Goldman, every year only in Frankfurt or in Europe, we hired about 200 to 300 people. So from that perspective, we are as well rarely taking juniors who come right out of business school, and then we hire people that we know. Most of the people that today work for me, with me, have worked for me and with me already at Goldman's. And then we have not the ability in the same way like Goldman has that to kind of train and educate juniors, Berufsanfänger, so to speak, because we have only 16 people. Yeah? And whereas at Goldman, you've got a lot of people and you can really afford a training organization and a formalized training. So that's why I'm always saying the investment banks have to kind of provide us with talent, and we hire them a lot and pay them a fee, and part of our fee is our Ausbildungsumlage that we pay the investment banks to kind of train the junior talent on the buy side.
Okay, maybe connecting to that, what you just said, recently there has been significant discussion about private equity recruiting practices. I mean, you at CVC do not hire too much people, but you also mentioned that at some point those investment banks, educate your future talent. So, for example, Jamie Dimon, the JP Morgan CEO, also criticized that PEs you often sign contracts with JP Morgan analysts even before they really start working. So as someone who has seen both sides, as Goldman and at CVC, what is your view on those practices, and how do you handle it at CVC?
The practice is such, there is freedom. Yeah, and if you kind of say you have a job with Goldman's or with JP Morgan, and you kind of think this is the sort of the natural way to kind of get accustomed to the financial sector and financial services industry, why shouldn't you kind of think 2 years ahead and say, okay, in 2 years I might want to go to whoever on the buy side, and I could even sign a contract or pre-sign a contract. Now, again, as I said, this is normal. There's freedom of choice for everybody. If you want to go and train with JP Morgan and then go to join KKR or CVC or whomever, should be freedom. Why should you disallow that from happening? And again, as I said, we are large and big clients. Our industry, private equity industry, pays as a regular fee income to the investment banks in large banks, probably amongst the top dollars for the investment banking division. And part of that is Ausbildungsumlage. Yeah? We pay them as well to train the junior people, and then we take them. We don't take anybody. We take some people of them who as well like it to go onto the buy side, which is a difference. And if somebody wants to join the buy side, any contractual obligation not to sign a contract is, from my perspective, quote unquote, ridiculous. And I never, when I was even on the other side, I never believed in that, because I always say there is no slavery. Yeah? You should be free to do with your careers what you want to do. Very simple.
So throughout your career, you have taken significant risks when switching industries and jobs. How do you manage your own personal risk, and how does it now differ from the earlier stages of your career?
What do you mean with personal risk?
Risk in the sense of, for example, switching industries, jobs.
Yes, sometimes in the beginning it was, the risk was was in the beginning much bigger. And I was it's kind of like investing for your age retirement account. When you're young, you can take a higher allocation to public equities or to equities. If you're older, obviously you know that there is some biological solution for you at some time. So then you are kind of taking less risk. And that's what I felt for me. The jump from medicine into consulting was the biggest risk because nobody could say if it worked out. From McKinsey to Goldman's, it was as well a risk, but you can manage this risk. And quite frankly, from the sell side or from Goldman, where I had done already a lot of buy-side deals with regard to investing Goldman's PIA fund at the time as well in certain deals, that was not anymore such a big risk. It was just after I retired from Goldman, giving the freedom to do that. What I like doing best is basically deals, whereas in Goldman's, at the end, I found myself more in, particularly in this time of the year before Christmas, in New York, in windowless rooms, which is allowed in the US, and discussing the bonus allocations for 5,000 investment bankers, which is a pretty boring job because you have got everybody, every department showing up there with their people and telling you that they all single-handedly rescued Goldman Sachs from bankruptcy, and that's why they should have an extraordinary bonus. And then you have to always kind of tell them, no, that's not the case, and you get less, and so on. So this is not really sort of what you have started for, and that's why kind of the move to the buy side and joining CVC and having the chance to kind of help as well CVC, for example, with some experience through an IPO. When I had done the Goldman IPO, I had experienced the Goldman IPO as a partner pre-IPO of Goldman and post-IPO, and we have done, you might have seen that, we have done at CVC as well an IPO just this year. That was something very rewarding and, made fun and got myself as well, not only to our fund deals, but as well for the corporate to interesting deals, and that's why it is sort of the logical final step of my professional career. I don't see a significant risk now for my further career there, and my health risk is probably higher, that I one day kind of get up and the questions here are too complicated and I faint or I get a heart attack or something like that. And my biological solution is coming pretty quickly. No, but the risk goes gets always lower.
So you mentioned the CVC IPO earlier this year. What do you think is the advantage from being public for CVC?
This is now, I can now talk about 2 hours about why should an alternative asset manager be public or not public. And I don't know if that's interesting for you, but I will try to make it shorter. So in general, you could argue alternative asset manager who runs a fund model, which means basically we are kind of taking money from pension funds, from insurance companies, putting that in a fund and invest it, and getting compensated from that through management fees, the committed capital that they commit to us. They have to pay 2% of this capital year after year as a management fee, and then we get 20% of the value we add. So if we buy a company and we sell it, we buy it for 100 and we sell it for 200, of the 200 we get, of the 100 more, we get 20% for ourselves. So now you could argue, why should you go public? And the rationale or that speaks against it is that if you kind of go public as a company, the GP, i.e. the general partner of the private equity firm, is compensated by this management fee earnings, the 2% and the 20%. Now the 2% are very stable. They're very good. So they are kind of valued by the analysts in the public market with a, call it 15, 16, 18 times multiple. The performance fees or the carry, so to speak, that you get, i.e. the participation in the value add, the 20%, this is very lumpy. So an analyst might pay you only 8 times, 7 times, whatever, or the market will pay you 7 or 8 times for that. So if you kind of now say, okay, I want to kind of take this thing public, isn't that a point where you as a general partner try to optimize the 2% fee and not anymore the deals? Whereas your investors who invest in the fund are very interested in the carry. The fees they don't like because they have to pay them. So isn't that leading eventually to a divergence of motivation and an unalignment of interests between the investors in the fund and the general partner, the private equity firm? So that is basically the starting point where you could say, fundamentally, a private equity company that runs a fund model shouldn't go public because it leads to an artificial incentivation to kind of not anymore focus on your deals and the returns that you make with the carry, but more focus on getting more and more funds in to kind of have an additional fund, an additional deal, because you get always your 2%, and the 2% comes stable like a coupon from a fixed income. So, do you understand what I mean? Or have I taught you? You're smart people, so you should understand it. So now you can say, okay, general, if you want to have permanent capital, which is IPO, you get some permanent capital in your shareholder structure, then you should become a Berkshire Hathaway or should become Warren Buffett, but as long as you're a fund model, you should not go public. And that's the starting point. But then you kind of start, are there some reasons why you nevertheless, despite this sort of divergence or of interests or a conflict of interest between your investors and the GP should go public? And there are 3 reasons. There's reason number 1, in order to grow in the market, you have to kind of, as an alternative asset managers, not only work in private equity core products, but you have to start as well additional strategies. There is a large flagship fund that we have with 27 billion, but we have got as well a private debt strategy with 56 billion. We have private debt means, you understand what private debt is. You have to have a growth strategy. You have to have an infrastructure strategy because your investors and your partners from the money, from the pension funds and from the insurance company, they want in order to achieve their return requirements and risk return requirements, they cannot only invest in one strategy, they want to invest according to their needs, to their maturities, to their cash outs, to the risk they have themselves. For example, life insurance companies, they have to have different strategies in order to kind of get the returns according to their sort of maturities and so on. So you have to basically offer them different strategies. If you want to start a different strategy, if I'm a large private equity LBO shop and I want to start an infrastructure strategy, I as a GP would have to seed fund that strategy, i.e. I would have to pay my own money into this fund. And that I couldn't do if I didn't get somewhere permanent capital. That's so reason number 1 why I want to go public, because I get access to the capital markets. I can get equity, which I could use and invest as a seed money in new strategies. I want to go to new strategies because otherwise I'm getting not interesting enough for my fund investors because they don't want to have 50 different managers. They want to have 1 or 2 or 10 alternative asset managers. So that's reason number 1. Reason number 2 is you have a generational shift. If you build in your general partner, i.e. in the private equity company, if you build some goodwill, that will be handed from one generation to the other. You can easily imagine if you don't have a market price, the generational discussion between the old guys and the more junior guys is pretty heavy. So you want to create a market by which this goodwill or this equity value that you have been built is traded with the public and hence there is as well then the possibility to kind of exchange interest at market prices, because you're public, to the next generation. So that's the second reason why of that. And then the third reason is, and that was specifically for CVC, that we had strategic investors, i.e. KIA, which is the Kuwaiti Sovereign Wealth Fund, GIC, which is the Singapore Sovereign Wealth Fund, and HKMA, which is Hong Kong as well, Sovereign Wealth Fund. They were in our GP with a minority position, and they wanted to have as well some liquidity for their investment, because they started to help and fund the general partner in the beginning, and after some time they want to get as well some money back, and you can as well only do that once you're public. So I say generally no. Then there are three reasons why you can do that, and now you have to say, and under which conditions can you do that? And that's the learning that we had from Goldman and the learning that I have from CVC. You can only do that, and that's going back to where you asked me, why is it that these organizations are kind of high-performance organizations? Because you don't want to change the culture of these organizations. So you have to kind of think, what are the mechanisms by which these organizations are driven? And do these mechanisms or this DNA, is that changed in an IPO? Or how can you maintain that? And in Goldman, for example, we kind of came with the conclusion that there were partners in the beginning, then we did the IPO, but we maintained this partnership culture. Still, Goldman by today elects partners, but the partners are nothing else but employee stockholders. Yeah? And it feels different, but you know, the culture of partnership, electing partners all 2 years, having this process to elect them, and so on, which is at the end of the day nothing but you get allocated a couple of shares. Yeah? That was very important because it transferred as well into the inner decision making, to the inner linking of interests of the different people together. At CVC, the same is true. We have a very unique system in incentivizing our people. At CVC, you know, or let me put it that way. In general, in private equity, people who are working in private equity are incentivized by the carry, i.e. out of the 20% value added, the general partner, the private equity firm gets, a certain amount is put into a fund, then this fund produces this and that carry, and you as an employee get a certain percentage of this carry, basis points. That's the normal model. In CVC, it is different. We are not incentivized as individuals by the carry that a certain fund produces. We are incentivized by the carry that the deal that we personally have worked on is producing. So if I buy Breitling, and Breitling is a great deal and makes a lot of carry, I can exactly calculate which percentage of the 20% carry gets into my pocket. And everybody who works with me on this deal understands exactly what he gets. So this is driving our behavior, because it cuts both ways. If Breitling goes bad and we are losing money, I have to pay in. So this is the ultimate alignment of a CVC deal doer with the interests of the investors. And that drives as well our behavior, because we hate losses. Our loss ratio as compared to other private equity firms is significantly lower. I hate too much leverage, because then the risk is high that I might lose money. So we kind of drive leverage around 4.5 times, where other private equity firms are kind of more 5, 6 times, depending obviously on market situation. And we are kind of staying, if something goes wrong, long time with our investments, because we don't want to lose them. We don't want to lose money. And that's driving the culture, driving the behavior of the company. So everybody stays from the beginning of a transaction till the end of the transaction, from the entry to the exit, with this company. Whereas in other private equity firms who are kind of incentivized by the fund carry, they kind of have more socialism, because all good deals are kind of going into a pot, all bad deals going in the pot, and you get a percentage point about that. So if you have a bad deal, you say, okay, fine, I throw it over the fence. It's kind of socialized away. And if you have got good deal, you say, oh, not so good, I nurture now the fund carrier. Then I have to kind of go again and talk to the head and suck up to him to say, I kind of did this deal, you should give me a higher allocation on the general fund, which is kind of leading then to the same type of discussions that I just described before at Goldman, where you discuss with people, what's the right bonus or not the right bonus for you. So, and that's then what the right fund carry percentage points for this and that individual. So this, going back to this IPO again, this mechanism we didn't want to destroy because it drives the behavior and drives the logic and the morale of our people. Direct incentivation, direct responsibility, entrepreneurial freedom, decentral organization. That's how we think. And we have done that by making sure that even in the IPO, the carry that is now going to the public shareholders is only 30% of the carry that we produce. The remaining 70% remains to the, i.e. from the 20% carry, only 30% go to the GP. All management fee earnings go to the GP, i.e. to the public company. So the public investor participates in the earning stream of the fees. He participates, however, not fully in the performance fee, i.e. in the carry. Only 30% go into the entity that's public, and the rest stays private with us as the partners and the deal leaders and the people who work on that. That leads basically to kind of maintaining this direct responsibility for your deals, and that leads as well to the direct alignment of interest between you as a deal doer and the fund that basically, and the people who fund, who put money in the funds. Long-winded way to say, in general, no, public, yes, some reasons, provided you're kind of maintaining the culture. And we think, as of today, that we have been able to do that. Sorry for kind of talking too long and giving you a lecture about that, but perhaps you learned as well something, despite you are all very smart people already. I would have, if I were in your position, would have loved to hear that before, because then I would have gone to private equity directly and not done the deviation through McKinsey and Goldman's. Anyway.
Yes, definitely, thank you for the elaboration on this.
If somebody has a question, just shout and sorry, because it might be too complicated for you, but no.
Yeah, I mean, sure, shout, but there will also be...
I look in your faces, and some people kind of seem to understand, some people seem not to understand, but anyway, that's how life is, yeah.
I mean, there will also be room for questions afterwards if you don't want to shout now. So just remember your question until the end. Thanks for the elaboration on this complex and ambiguous topic. Maybe moving back to you as a person a bit more. During your career, as you mentioned it already, the Vodafone Mannesmann deal, but also Daimler Chrysler, you contributed to many of the largest and impactful deals in the German region or even transatlantic. What is it, or with such an accomplished career, what is it that continues to motivate you and drive your passion for the financial industry?
Difficult. I know nothing better by today. If I would open my private practice, I'm still a kind of a certified medical doctor, so I could start tomorrow, kind of go opposite street and open my practice, but I think nobody would come. So from that perspective, as I know nothing better, still, if there is a deal and I can add value, that's fun, and that's why there is demand for my services, my know-how, my firm, whatever. So that's why I still continue to do that. If you kind of try to find a philosophical answer to this question, it's obviously always the fun of having to do with people. That was as well something which I kind of always liked in medical studies and as a doctor, because you're kind of really working with people all the time in different ways. Second, you are the master of your own destiny if you do transactions. and you kind of have as well the risk function with you. If it's going, at McKinsey that's less so, because you are kind of talking all the time, and every 5 minutes you talk, €5 go into the Sparschwein. Yeah. In Goldman you have the risk function because you only get a fee if the transaction is successful, but you can never lose. Yeah. So you lost only time. On the buy side in private equity, you have the full risk dimension, because if something goes wrong, you lose money, which is fun. Yeah. Because if it works out fine, you make a lot of money. So having this enjoyment of transactions, fun, dealing with people, improving and leaving, quote unquote, a certain mark is definitely something that's interesting.
Thank you.
So, in a previous interview, you mentioned that during your time at Goldman Sachs, your responsibilities increasingly shifted towards management tasks, even though you enjoyed the working on deals, which you've also expressed now. So, how has this changed in your years at CVC, and how involved are you in the deal-making process now?
This is what I said. At Goldman's, at the end, you're then only a coverage person to kind of do some calls, and then you're kind of becoming increasingly a manager, which is interesting. My friend Paul Achleitner, who hired me at Goldman's originally, he always told me that he liked to be at Allianz, because it's a huge organization. You can manage a huge amount of people, and you have really influence. It's kind of like working for the Prussian army. Great thing, being a general of the Prussian army. Despite he hired me at the time and got me excited, because he says it's kind of a bit more like Goldman, and as well private equity is a bit more like guerrilla fighting, sort of small group, you get out of the forest, you try to hit, then you take your prey and you go back into the forest. So that's the difference. I personally liked more guerrilla fighting, and not so much Prussian army, despite the Prussian army is a great organization, a great thing, or every army, not every, but anyway. And so from that perspective, that's a bit the difference. And I felt that I was going a bit too much in direction of Prussian army with management responsibilities, and wanted to go back into the sort of guerrilla fighting, or whitewater rafting, or whatever you call it, and that's smaller groups, smaller people, direct responsibilities, decentral management, entrepreneurial spirits, and defining really what you want to do with a small group of people yourself. This is just rewarding, and it's just like university. Some of the professors, the best scientists, they over their career get promoted to chairs of a faculty and then chairs of the university, but where they started doing research originally, they haven't got in their mind anymore. It can be as well very rewarding to manage a university, but that's probably not where you started to become a professor. And the same thing was for me when I started to get into the deal making business. I didn't kind of want to end up with kind of, and I probably couldn't have, because I'm German and European. I didn't want to run a kind of a big organization. I rather wanted to kind of do the things. And you have to know what you are good at. And I'm definitely not good at running a big organization, that I know. I get impatient.
Thank you. So maybe to have some kind of future outlook, I would be interested in how do you see the private equity industry evolving in the context of growing uncertainties due to wars and crises, etc., but also under the growing regulatory restrictions in the next 5 to 10 years?
So that's a long chapter again for 2 years, but very quickly. Number one, obviously the private equity industry has gone through different cycles, not only economic cycles as well, sort of the understanding what private equity can do and can't do. I remember 2002 or 2003 there was the whole locus discussion. So in Germany or in the European region, private equity was seen pretty negatively as people who were mainly kind of done financial restructuring and, you know, kind of putting some leverage on the company, then letting the company alone. And, you know, then the company bought itself back. And if you were lucky, you kind of, they delevered and you had the equity and were kind of making a return. This is not anymore possible. And the perception is as well that private equity is really a solution provider for many problems, ranging from succession with families, partnerships, improving companies, really kind of getting from good to great, and being able to kind of refresh the governance of some companies. Because at the end of the day, what does private equity do? We are not managing the companies, but we are selecting the right manager, the right talent, and we are pretty rigorous in implementing what we think is good for the business. And there is no dilution of interest because we are you know, laser focused on what this business does. And that's kind of improving and contributing to economic growth. And that's what we are trying to do and where we find our rule, and that gets recognized, I think, as well by society. So from that perspective, you know, I think on that trend, the industry is growing and will continue to play a role. Obviously, in the long time of low to no interest rates, private equity was as well a sort of easier game because leverage was basically more or less free, and you could kind of, with limited risk, turn big wheels. That has changed as well, and you have now to focus again to kind of what I'm always saying, from good to great, from a good company to a great company, and that's what we'll focus. And that will lead as well to a divergence of the private equity industry. Altogether, alternative asset managers, you will have the big platforms who kind of have the capital and will kind of continue to get capital from the pension funds, from the sovereign wealth funds, from the insurance companies, who have different strategies and who focus on the right things. Then you might have small thematic funds or regional funds who are small and kind of are able to here and there find a good sort of gold nugget. But in the middle, it's tough to survive. And that's how I see the industry developing over the next 5 to 10 years. Basis, however, is that over a longer period of time, alternative asset managers and private equity has been able to demonstrate that they kind of outperform public markets or public funds, public market funds, with regard to the performance. Because in general, if you look at, you know, you kind of have an interest, you have a return of, depending if you take an arithmetical or a geometrical mean, somewhere between, and pre-tax or after-tax, somewhere, let's call it around 8% or 7 or 8% over a long period of time. And the best private equity alternative asset managers have been able to kind of outperform that regularly. And that kind of shows that there is a value in doing that. You obviously have a disadvantage that you are not as liquid as you are in the public market. So this liquidity discount or this liquidity disadvantage brings you, however, an overproportionate add-on in returns as compared to public markets.
So when evaluating potential portfolio companies, what specific criteria does CVC prioritize to realize these extraordinarily high returns, and how does this compare to the approach of other private equity firms?
Well, you know, this is in general, for private equity altogether, I always tend to say there are no bad companies, there are only bad transactions or bad prices, yeah? However, we as CVC, we rather buy a good company at a fair price than a bad company at a good price. So we are not turnaround artists. We try to focus on businesses that have a growth potential, and where we can, with our know-how and understanding, in partnership, in general, we do a lot of partnerships, I can tell you exactly why, improve this company, and again, from good to great. And that's what we have been able to demonstrate in many situations. And in my time in CVC, we have been able, in the German DACHI region, we have done 12 transactions, and with the exception of one, all have been partnership transactions in which we kind of, with founders, with families, contribute their assets, we money, they get a bit of liquidity if they need it. We kind of build something together and develop it and then sell it together. That's sort of the model. And that's what is specific as well for CVC. And that's a specific as well because these partnerships you can only enter into if you know who your opposite is. And that's why we have as well put a very decentral network of offices and senior deal leaders on the ground. So we are not governed by somebody sitting in New York and judging the world from Wall Street or from the city. We are kind of our own, mastering our own destiny. It's a kind of a small group going back to my guerrilla troop that sits in Frankfurt or in Madrid or in Milan. And they kind of define what they want to go for. And they kind of almost mentally indebt themselves towards the fund, take the money, invest it into the company, improve the company according to their principles in partnerships, according to their strategy in their given market, because as well in Europe, it's kind of a pretty compartmentalized socio-economic system, and then kind of make money and then kind of pay the money back to the funds with a return and keep a bit for themselves. That's a very simple model. And that's what we try to implement as well with the portfolio companies we look at. And then we have for every portfolio company, when we go in, we underwrite a certain business plan, a certain development plan, mostly with a VCP. We call this value creation program, where we kind of do certain things for every company individually and different, and we kind of follow that through as to our system with the same team from the very beginning to the very end. And that's, and hopefully, so far it went out, it turned out pretty well for us, at least in the DACHI region, and as well for CVC as a total group. And that's what we are going to continue. But in general, we are as well very opportunistic. So we are not kind of saying we invest only in sort of financial services or in raw materials or in consumer goods or something pretty opportunistic. That's why I'm saying there are not good companies or bad companies. There are only bad deals and bad prices. Yeah.
Okay, maybe just again connecting to that, what you just recently said, CVC has, especially in Germany, made significant investments in the supplementary nutrition sector with companies like the Quality Group, which is like the company behind ESN, the ESN brand, or also More Nutrition, which is quite prominent, I guess, around, especially for people who grew up with Instagram, and also Seneberg in Germany. What is it that attracted you, or is it even the sector that attracted you, or are those these specific companies?
No, originally it's not the sector, not why we think it's a sector. If at all, it has been that we were looking in a time where it was in Germany increasingly difficult because we were kind of in a cyclical downturn. Are there secular trends in industries, and the direct-to-consumer marketing and to kind of embrace the social media as a sort of a selling tool was just evolving. And then we looked at what are kind of successful models, and these are as well kind of were very much founder-led. And at a certain time, all of these founders say, okay, now we have kind of grown from a garage to a sort of a reasonable business, but we now kind of, now it gets really from, sorry, I don't mean it negative, from Damen tennis to Herren tennis. And, but sorry, not, please don't misunderstand that, yeah. I think I would lose against every woman in tennis anyway. So, but it gets more serious, let's put it that way. That was the right word. And there we need some institutional support. And that's something we understand, and that's why we have it. Starts with professionalizing management, trying to think about a strategy development rather than kind of gut feel, looking at cost, supply chain, all of these things. And that's where we have a special expertise, and that's what we have done, and touch wood again. This has worked out fine. By the way, the same model like we did in Tipico, which started with a sort of founders, and they were at 100 million EBITDA, and then they said, okay, that's great, but we want to build further, and we want to go for the whole Monty, and then we helped, and by today it makes 450 or 400 plus EBITDA. So this is something, that's the pattern we are looking for, but not because it is vitamins, minerals, and supplements, or not because it's apparel or whatever. Rather the sort of general pattern that we see.
Okay, thank you.
Okay, thank you. And now, as a last question from our side, are there any tips that you have for students who want to pursue a career in the financial service industry?
Yeah, 3 things. 1, whatever you do, try to do it at the top. Yeah, regardless, what I always said, try to be at the top percent, top 2%, regardless what you do, because that will kind of give you the entry ticket to something. If you do it in sports, or if you do it in your exam, or if you do it, so try to be there. Second, try to brand yourself. That's what I've said already a couple of times. Why did I manage to kind of make a okayish career? Because nobody doubted when I said I was a McKinsey partner, I was a Goldman partner. I don't have to talk about, my background also. Tick, tick, tick. Yeah. If you had to say, I was just saying that to your colleagues earlier. Yeah, I worked for Joe Blow, but Joe Blow was actually a great company, and I did this and I did that. So 5 minutes are already gone. Yeah, if you're kind of branded, there's the brand value that you've built for yourself, and that helps you to kind of advance faster. If I see CVs and I see, okay, done, St. Gallen, Stanford, whatever. So I say, okay, let's talk to this guy. He seems to do something right. Plus he has got this and that. So it's, again, a bit of an elitist concept, but I think it works. And if you want to do financial sort of large cap or bulge bracket careers, that will have some bearing. But then, and the most important thing at the end, because you won't only be able to be amongst the top best, and you will only be able to kind of find a home in great brands and great companies. By the way, the brands stay in general as well for great cultures, if you really have fun on what you're doing. So, and I said to the junior people, if in the first year at Goldman, Morgan Stanley, whomever you work for, McKinsey, and you don't have in the first year, at least for consecutive 14 days, real fun what you're doing, then you're probably in the wrong profession. Yeah? Goldman in the beginning as an analyst or whatever is really tough. Yeah? And you will hate it. Yeah? McKinsey the same. It's kind of, by the way, it doesn't have to be like that, but they somehow, the people like you, they have a software defect because everybody thinks, yeah, now I have to work a bit more. I have to work a bit harder. I want to go this 2%. Yeah, 2%. But the others want to be at 2% as well, top 2%. So you have to put in an effort, additional effort. And you work hard instead of smart. But anyway, that is what it is. But if you don't find in the first year 2 weeks consecutive fun in something, then you should seriously consider if you wouldn't like to do something else, because you will never be good at the top of something which you don't like and which you genuinely don't feel, a kind of burning for, or kind of getting up and saying, okay, now I kind of beat this guy because I kind of, in this deal, I'll get the additional, 5% price concession for him, or the governance thing, or this or that. If you don't like that, because you'd rather kind of, listen to a violin concert, then you should probably go into culture or doing something else. That's exaggerated a bit, but that's would be my 3 pieces of advice.
Okay, so thank you very much. We'll now be welcoming questions from the floor as well.
Yeah, just in case of any question, just raise your hand, and Matti will be so kind to bring you the microphone.
Planted questions.
Yeah, thank you very much for your insights. Maybe reflecting on your time at Goldman and now CVC, what differentiates a good deal from an exceptionally great deal?
The returns.
Maybe something else as well?
Well, long-lasting, this going back to the old McKinsey definition of a great strategy, which transferring great returns, long-lasting competitive advantage. Yeah, that's what we try to build as well there. But at the end of the day, it lies in the returns to a certain extent. Now, the returns could be in buying. This is what I'm always jokingly say. No, you think that I'm arrogant. I'm not arrogant, but I'm saying it anyway. Business schools and business in general is very simple. Yeah. Buy low, sell high, revenue up, costs down, and incentivize management in the right way. These are the 3 things. And if you do that, you'll be fine. As a medical doctor, I would have wished I had such a simple principle to kind of be helpful to every patient. No, it's much more complicated. So from that, but I mean that as a joke. You don't laugh, but anyway, I think it's a joke. But so from that perspective, I think if you do that, but for me personally, it's really kind of, we live in a capitalist environment, in a market economy, and great deals are kind of as well somehow categorized by what are the returns on these deals, and do they work out or not?
Thank you.
I think in the back is,
And by the way, so I'm not kind of seen as a sort of cold-blooded, money-driven person. Obviously, if you create a great culture within a company and you kind of deal with in the right way with human resources, with recruiting, with incentive systems, and so on, that will transfer long-term as well in a great return. Yeah, because otherwise you wouldn't do it, or you shouldn't do it. That's as long as we believe into sort of the market economy and democratic systems, as tedious they are, but we don't know of any better.
We talked about deal carry versus fund carry from the perspective of an investment professional, but it is also hard to argue for a deal carry towards your limited partners because they essentially lose the downside protection without a hurdle rate on the fund performance.
Hold it. So the fund has obviously a minimum requirement, 6 or 8%. You get your deal carry only paid out if the fund as a total makes the hurdle rate and if the fund is in carry altogether. So he has got this quote unquote insurance. So only if the fund is in carry, then the GP gets the carry and the GP distributes the carry then to, not according to a percentage point allocation, but to, where is this carry coming from? Is it coming from this deal or from that deal? And who worked on this deal? And before I do the deal, at the closing, I have a carry sheet where I know, okay, Dibelius did this and that amount, this and that, and then this, and everybody knows exactly what he gets. And he continues to work on that. And I know exactly when, whatever, typical Breitling, Messer, whatever, if there is this and that happening, what has that potentially sort of impact on the exit, and how much I might participate or not participate. And if it's going down and I'm losing money, I have to pay in. So that's it. But the LPs, They like the system because they know that we as deal leaders and deal doers are exactly incentivized in the same way like them. You know?
Okay, thanks. So you do have a clawback clause in place.
Yes.
But you're also then a little bit dependent, at least, on the good performance of your colleagues.
Yes, but if we wouldn't return our hurdle rate, we would have a completely different problem because we wouldn't have the next fund. We couldn't raise the next fund. So luckily, CVC from its fund 1 to its fund 7 now demonstrated, because there we are already exiting. 8 we have fully invested, but it's pretty junior, so I cannot promise you that. But from fund 1 to fund 7, we always provided more than 2.1 whatever times net after costs to the investors. So there is not a discussion about a hurdle rate of 6 or 8%, but this is kind of transferring into an IRR well above 20%. And that's kind of going back to 86 to now, 7 is the vintage, is a 2012 or 13 vintage. So from that perspective, we are fine. If we wouldn't do that, if we wouldn't meet the hurdle rate, next time we went out there and tried to raise a fund, the investors would basically have closed doors. Which is as well strange, because they always kind of imply that the history of the path is an indicator of the future, which, yes, often is the case, but not necessarily so. So that's why we have to work every day hard again to kind of fulfill this promise and the prospective idea that the investors had when they kind of committed, again, get money to you.
All right, I think we have time for one last question. If there's one, yeah, somewhere around there, Matti.
Hello, my name is Amr. First of all, thank you so much for coming here today, and thank you to HIC for organizing the event. I just wanted to ask, I'm more steering towards private banking, and I'm sure that you have acquaintances who work in that field. So I was just thinking, what do you think of getting into that career long term?
You mean private banking as a private wealth management?
Exactly.
Yeah. I think, one, it is probably a recession-proof business, because there's more and more wealth accumulated, at least in the Western world, over less and less people, So from that perspective, if you have got more money, people always think it gets easier. It's not the case. It gets more complicated, because you have to think, where and what do I do with the money? And I tell you, losing money, I've been in Goldman and kind of saw my personal wealth in the kind of great financial crisis going like that, because the Goldman share went from, I don't know what, 80 to 20, and I tell you, it feels much more painful to lose money than the effort to make money. So from that perspective, people are kind of looking, how can I risk adjust my personal wealth? That needs advice, that needs special knowledge. So from that perspective, I think it's a recession-proof for the next foreseeable future, a recession-proof profession. And so from that perspective, there's nothing wrong with that. I think, however, before you kind of become a private wealth coverage person or asset manager for wealthy individuals or family offices or whatever, you should have a basic understanding, at least in one area, either in the public markets or in private markets, about the transactions and what's actually happening with the money, or how it works, how is value created, in order to kind of have a basic understanding to kind of then give best advice. I don't believe necessarily that you can do that by reading a couple of smart books and doing it and being a spreadsheet wizard.
Thank you so much.
All right, thank you. Yeah, so I guess we are done now. Thanks a lot to Mr. Dibelius for taking his time to come here and answer all our questions. I'm confident I'm not the only one who leaves the room smarter than he came in. Yeah, thanks a lot.
Appreciate it. Thank you.